Welcome to today's LinkedIn Live session hosted by Marvin Labs. We're zeroing in on UK and European durables, from apparel and footwear to home goods and sporting retailers. As a panel, we'll explore how retailers are responding to a whole host of impacts, whether that involves tightening margins, adjusting pricing strategies, or finding ways to differentiate themselves. So we're doubling down on value, others are defending premium, and we'll follow and look at all of these. Shristi, Alex, and I will dig into some of the following. Who's gaining share as consumers trade down or hold back? Where supply chain risks still linger in the background? How interest rates are filtering through to earnings and share prices? And how analysts are using AI to stay ahead of a flood of data during the earnings season. As always, all analysis is backed by Marvin Labs' investment analysis platform, which has just interestingly launched several brand new AI chat and asynchronous agent features to further speed up the analysis of retail companies. Give them a spin in the link in the comments if you'd like to after the event. But first, I'd like to introduce Alex Hoffmann and Shristi Shah to introduce themselves. Alex, over to you first.
Yeah, hi, I'm Alex. I'm the CEO and founder of Marvin Labs. I spent most of my professional career in financial services, investing, and as of about 1.5 years ago now, I founded Marvin Labs. And as James said, at Marvin Labs, we just introduced our AI chat feature, which allows analysts to have a sparring partner and a very knowledgeable colleague that they can discuss some investments idea with. I'm looking forward to having this chat today.
That's great. Shristi, would you like to introduce yourself as well?
Sure, thank you. Hi, my name is Shristi Shah, and I just completed my MSc in Investment and Finance from Queen Mary University, and I'm FRM Level 1 certified. I've done my research projects in the fields of interest rates and equity markets. And yeah, I'm very much excited and looking forward to the meeting.
Great. Well done on your MSc as well. That's no small achievement. So fantastic on that achievement. We're going to get straight into some questions. And as always, if you've got a question and you're watching us, please pop it into the comments on LinkedIn and we will try and answer that as a panel. So the first question we're going to look at in this space, which I think is always a good one to start on, is the whole debate about premium versus value in terms of who's winning share as consumer habits shift across UK and European markets. So I'm going to come to you, Shristi, first around the question about, do you think people are starting to go for cheaper brands based on what we see in the market, or are premium ones still doing well despite everything seeming to cost more all the time?
Yes, so we're definitely seeing a shift in the consumer behavior, and it's nuanced. With the inflation cooling, but interest rates still stubbornly being high, households are being more selective about where their money is going. And many shoppers are trading down to the value retailers, like thinking about B&M or Primark, because they need affordability, especially for everyday or seasonal purposes. But at the same time, premium players aren't collapsing at all. In fact, those with the strong brand equity, like JD Sports, which sells like Nike, Adidas, Puma, they are still attracting demand. And that's basically because of the wealthier customers are less rate sensitive. And in some categories like sneakers or premium apparel, people still want to treat even when the budget is tight. That's what I feel.
That's good perspectives. Alex, do you agree with that?
Yeah, I think we're seeing a hollowing out of the middle a little bit. So if you're in a middling price segment, when kind of a typical reaction function, right? Whenever there's a bit of economic stress, you see consumers migrating down in that segment, while traditionally and we're seeing this now as well, the more premium is at least less affected. We're I know we're kind of talking about durables today, but what you interestingly see on the staple side, and I think there's a learning here on the durable side as well, as you're seeing a trend to retaining brand names, but going for the on the staple side, the food side, for example, you go for smaller portion sizes. So you see kind of an interesting trend where you see lots of consumers not willing to trade down on the quality, but willing to trade down on the quantity.
I think that's a very good point about quality and quantity. I used to work for both Tesco's and Marks and Spencer's, so have seen this space firsthand. I think for me, it's interesting at this point in time. I think you can definitely see consumers leaning towards sort of more value-led brands. And you mentioned Shristi B&M, which I think in its trading update for recently pointed about 8.5% year-on-year growth in terms of revenue, which is pretty decent. And I think models like B&M and Primark are gaining traction. But also at the flip side, you look at others and, you see some of the premium brands like Marks and Spencer's is obviously a bellwether. And I know, again, slightly different than their food division, but you look at their collection range, which is particularly notable, and that's outperforming their value tiers. And I think a quote I've seen in some analysis recently was that they quoted directly that our customers are making considered choices and are still trading up on quality where they see value. And I think that's a really important point. There, as you say, Alex, not just the dynamic about quality and size or volume, but trading up on quality where they can see the value. And I think that's for me, an important point about that sort of balance between premium and, sort of value, sort of players in the market. I think where there's the biggest issue, and I think this is probably not new, but I think it's being exacerbated at the moment, is I think the squeeze is most felt with brands stuck in the middle that are not cheap enough to win trade down. So they're sort of, they can't get their models down, and you see that in some of the stats, but they're not premium enough to justify the pricing, particularly in the durable space where, it's not as easy or maybe not as local sourcing is not as easy to obtain sometimes as international sourcing on some of the durable goods. So I think, in summary, it's a really interesting space in terms of the value retailers appear to be, certainly from the results, holding up reasonably well with some strong players like B&M. The premium players, I think Marks and Spencer's is an interesting case study in point with their results, but the squeeze is coming in the middle.
I think you're mentioning Marks and Spencer, and I think one of the interesting things you see in their performance is you see kind of their own brands being kind of fairly resilient, while third parties are getting more difficult, which is really kind of the quantitative backup to the sentiment of customers are going for quality where they can see the quality, while not doing it for the label.
Yeah, I'd agree with that, and you can see that in some of the stats and the results as well. I mean, like I said, I mentioned B&M up 8.5%, I think, year on year, and then you also look at Primark up 6%, actually quoting that this is driven by its range rather than just incremental sort of initiatives and pricing margin changes. So I think that's particularly interesting. I mean, obviously you start looking as well at that dynamic of premium and value, not just across the generic statements, but also by wallet size in terms of variances between the youth sector and perhaps a more mature audience as well. And that's probably as relevant for Marks and Spencer's as it is maybe for some of the other younger fashion retailers out there. But if we move on from that sort of broad question about the current trends around premium and value, supply chain obviously plays a big part of the mix in terms of durables, and is obviously can be hit much harder than staples, in terms of current economic environment, interest rates, particularly in the UK pound collapsing this week as well. Shristi, I'll come to you first about supply chain problems. And do you think there are still some serious supply chain problems out there, or sort of companies getting to grips with that more now, particularly when you mentioned that word, tariff? People sort of seem to sometimes reflect on that quite heavily.
Definitely. So what I believe is supply chains aren't grabbing headlines like they did during the COVID. but there's definitely still a background pressure on the retailers, like costs like freight, energy, and warehousings, which haven't returned to pre-pandemic levels. So the margins are still thinner than they are used to be. For durables like furniture, electronics, the challenge is greater because these products rely on complex and global supply networks. Um, Even like small disruptions like shipping bottlenecks in Asia or fuel price swings can ripple through the supply chain and push up the cost. And for food, by contrast, it's often more locally sourced with like shorter supply chains. So the impact is less severe in the food industry. But we don't have like the closures of the independents like Stoughton's and Tappers, a 120-year-old furniture retailer that just announced it's shutting down. It reminds us of how difficult it is for like smaller players to absorb these kinds of cost pressures. And like large chains like Curry's, Dunelm, or Frasers, they can negotiate for better deals with suppliers and logistic providers, while like the independents often can't, leaving them much more exposed. So yes, while definitely supply chains aren't into the crisis mode yet still anymore, they remain a structural headwind, particularly for the durables and the sector divide. Big players adapting, smaller ones struggling, has never been more visible, is what I feel.
Yeah, no, I think you make a good point there. And I'll come back in a minute on the shipping piece, because I think that's an important one, certainly post-COVID as well. Alex, what's your perspective on this question about supply chain?
Yeah, it's supply chain is kind of an interesting thing because it, I mean, the current impact on supply chain is mostly a pricing increase impact. That's really what's happening, and that usually doesn't make the much of the headlines, right? I mean, if you think back through what we went through during COVID and why everybody was thinking about supply chain it's just wasn't that stuff became more expensive. It stuff became impossible to deliver. And that's really when supply chains become front and center. While just cost pressure is typically something companies will just absorb and fix in the background without aggressively talking about it. And you see this also when we look at what retailers say about their supply chains, right? They will have generic cost pressure comments, but nobody will really comment on massive shifts in their supply chain happening. Certainly not while they're going on, as long as it's just a cost optimization exercise. I think the only example where you've seen a company really talk about their supply chain prominently is Nike, when they're still kind of a little bit in the middle of their shift into their shift in Asia. But that's such a massive undertaking that it's kind of hard to keep it on the wraps. But if you're a smaller retailer, a mid-sized retailer, typically you're not commenting much on your supply chain, as long as it's just costs, right? It's you'll see it in your results, but nobody. You won't talk aggressively about your concrete initiatives to do something on supply chain. We'll keep things on a generic level.
Yeah, I think you touched upon COVID, and I kind of see it as a sort of this supply chain question is, when COVID hit a few years ago, you saw sort of severe visible disruptions, whether it be.
I mean, it's shortages, right? I mean, it is actual shortages of goods, which is something we hadn't experienced in like realistically 20, 30 years.
Yeah. I mean, you're right. I mean, factory shutdowns, everything, and shortages from, microchips, I think, to furniture foam was one I remember at the time that was a massive impact when you actually think about the effect on durables, particularly furniture, that an inability to manufacture foam. So I think what you see now, I see more in the sort of analysis and more in the commentaries, moving on from that period of what I'd say severe disruption to more that there are frictions there now, some volatility around lead times, supplier diversification, tariff impacts, which we'll come to in a minute. but it's almost like it's not gone away. The sort of some of the challenges of COVID, they've changed slightly, and of course the tariff piece has come in terms of potentially where some firms are maybe manufacturing their goods or changing the way they make their goods. Shristi, you talk earlier about B&M and mentioned them again. When I looked at their recent earnings in July, they sort of said, quote them directly, our scale and direct sourcing allow us to move more nimbly in replenishment heavy categories, which is an interesting one. And Marks and Spencer's, which again, I mentioned earlier, said that their UK-led sourcing model in foods, albeit not durables, but it's just an interesting approach, gave them greater resilience because of the UK-focused, sort of approach as opposed to international. So I think that balance about supply chain looking for local supply, tighter stock cycle, could work, and certainly maybe shifts the piece on from issues during COVID to now it's more about coping with issues that come within the supply chain itself. So sort of the crisis is over, as it were, but the friction hasn't gone away. Alex, I do want to just circle back on this question. We're talking about supply chain. I know Marvin Labs has got a tariff tracker, a real-time tariff tracker. Do you just want to touch upon what that is? Because I think it's quite relevant, because when you look at some of the comments around tariffs, they sometimes have a relevance to quite a few things, but particularly the supply chain questions.
Yeah, so we've we started out getting lots of inquiries from people about like how is the tariff discussion happening in the US right now actually manifesting in companies' earnings. So what we did is we built, and it's completely available for free, we built a tariff tracker, which basically goes through companies as they're reporting and filters out the earnings results, the tariff impact on the earnings. So it's looking at both what the actual impact is, and I think we're standing at about 8 billion so far of that impact. So that's in second quarter numbers. So this is typically the April to June timeline. And then it's looking at the at what companies say about their expectations going forward. And there the number is way in excess of 10 billion. And we've done that. We think this is a very valuable tool. We hear from people that they think it's helpful for them to stay up to date, and really that's why we're providing this.
Yeah, I think it's certainly, I found it very valuable that you're getting real-time updates when companies, Dell reported the other day, for example, and you just suddenly get a snapshot of someone saying, no, this will not impact pricing at the moment. Or I know it's slightly different to this conversation about UK and Europe, but when you saw some of the US retailers in the previous earnings round, trying to hold positions of, no, we won't be ever changing pricing, to others saying, yes, we will. It's quite I found that quite a useful tool. We've had a question just come in from Garesh Kuradia, if I've pronounced that wrong, apologies. The question is, could the switch to value brands be attributed to fast fashion and branding approach? Primark recently had a collaboration with Ford, Shelby, and so forth. Any thoughts on that, Shristi or Alex? If I start with you, Shristi, any thoughts on that, the switch to value brands being attributed to fast fashion and branding?
Definitely. I guess everyone is collaborating somehow. You can see Travis Scott collaborating with Nike, Primark collaborating with different designers with different lines. So yeah, definitely, I believe it can create a value for the market, because everyone's getting a chance, everyone is being recognized, because definitely Primark is a big company, tying up with them, it's going to be a huge thing. So definitely, I guess it can be a value-added thing, and it can bring progress.
Yeah, Alex, your thoughts on that one?
I mean, I'm clearly not cool enough to seriously comment on this, but it's interesting to see that these brand partnerships are now happening at a kind of more surprising ends of the spectrum, right? If they started with sports brands, and now you're really seeing them be present in kind of more as I would conceptualize as unusual parts of the fashion spectrum. But yeah, as I said, clearly I'm not cool enough to even know who Travis Scott is.
I think you are. I think you do yourself a misservice there. I think it's interesting for me, and it's a good question, Geresh. So thank you for asking it. I think the one that I sort of spin round the other way is I look at what's happened in the UK to Poundland, which is, although they haven't gone for major affiliations with luxury brands, they have tried to dilute their core purpose and their core brand and introduced foods and brought in fashion and different layers and different segments of fashion, and it's ultimately resulted them having real problems, and now I think being sold recently for £1. So I think for me there's always this balance between the core brand and partnerships and affiliations that may look sensible, but in the long term, how strategic and valuable are they? So that's a space I'm always quite wary of when I look at analysis and partnerships with brands. And I'm sure we've all got examples of brands that have partnered with brands that you would have thought that makes sense, but then it's led nowhere or caused issues sort of further down the line. C. Labusi, thank you for your comment as well, by the way. Bravo, Marvin Labs. So thank you for that. I assume that's not a question. So thank you for the positive vibes on that one, which is great. I want to swing round to a topic that obviously impacts all retailers, but particularly, the durables piece, which is about interest rates, particularly with UK and Europe, and UK in particular, which is sort of, I think, really caught in a very difficult space between interest rates, government borrowing, and the value of sterling at the moment. So, Shristi, I'll come to you first here about what's your thoughts on interest rates, particularly how they affect people and what they buy, and are some brands feeling that, do you think, more than others, back to sort of the premium and value question? And I know you've done a lot of analysis in this space, so feel free to share your depth of knowledge here with the audience.
Definitely, as you said, this is one of the most important forces shaping the retails right now, and high interest rate filters into everyday spending. I categorize them into two. One is the mortgage cost, and the other is the credit cost. So the mortgage cost is going to be the households on the variables, or newly fixed rate mortgages, which are paying hundreds more each month. And the credit cost being the borrowing through the credit cards or personal loans, which we use regularly. It's kind of much more expensive, but that combination makes people conscious with big ticket discretionary spending. And speaking of the durables, the sofas, electronics, or premium fashion, for instance, are some of the first categories to see demand slow down. Now, what I've been observing is a kind of polarization. Value retailers like the B&M are benefiting as shoppers trade down. The luxury players are holding up because wealthier customers aren't as affected by the borrowing costs. And the middle market is squeezed hardest. It's neither cheap enough for premium enough to justify the spend. And then despite these pressures, Curry, they delivered strong sales growth. And I guess they should thank that they're seen in the essential extreme conditions like fans or air cons during the heat waves, and the popular future-facing tech with AI-enabled laptops. Then that's why I guess their shares jumped nearly 17% in a single day after the results. And it's a rare sign of consumer resilience in an otherwise tight environment. So while high interest rates are dampening discretionary demand overall, the retailers that sell utility-driven products are still bucking the trend.
That's a very good summary, and I saw the Curry's results as well. Alex, anything to add on that around interest rates?
No, I think Shristi did a very good summary of this. I think it's kind of this it's this phenomenon you see often, that people in this economic climate delay purchases they can delay. because credit is more expensive, economic uncertainty is cropping up, the pound is losing value, so everything becomes more expensive, and you see this typical trade that people try to delay anything they can delay, really, and if you have customer durables that are typically more easy to delay.
Yeah, I never thought I would be seeing air conditioning units in the UK affecting the economy as much as they are at the moment. We don't normally have a climate that warrants itself to air conditioning actually impacting consumer spending, but this summer it certainly has. I think the piece for me about interest rates, as you said, Shristi, and you summed it up well, that there will always be that generic impact, and some more than others, like Curry's doing really well. But I think the dynamic this week in particular has been around this tightrope that's going on between interest rates, government borrowing, and the pound, and also caught in that is obviously the Bank of England, hinting on one way that if it cuts interest rates, that obviously further makes the pound less attractive, which again has more impact, and so on. So it's a really difficult balance. I think the one thing that I certainly didn't get right myself when I was looking and making my predictions about what would happen, this sort of, a sharp rise in interest rates followed by sort of a fast cut, the sort of V-shaped, is what I'd kind of expected. But I think it's not really panned out that way. We haven't seen a sharp rise followed by a fast cut. It seems to have got stuck halfway, and then a real challenge now about if you cut further, which will impact sterling potentially. You also then have the benefit on the flip side on government borrowing, but obviously elevated rates continue to impact retail and durables. So it's a really difficult balance. I mean, what's your thoughts on that at the moment, around that balance between borrowing, interest rates, and the currency itself, as in sterling? Is that something you've looked at or have any thoughts on?
Definitely, the interest rates affect the currency transactions as well, but I don't think so. I know much about talking on this. So yeah, I mean, definitely interest rates are affecting everything in the market, rather be retail or bonds or debt market or whatever. But yeah, I'm not in the right place to comment on that. Definitely.
No, that's okay. Just to swing it around, Alex, just a question to you about, obviously Marvin Labs AI investment analysis tool. When a company cuts its earnings forecast, how can you tell that's because of the economy or something fundamentally wrong with the business? Because it's sort of, you can already see there's some nice signals for companies to lean into here about maybe poor performance. So how do you think that works? How can you really dig into the analysis on a particularly on a retailer with durables as one of its key income lines?
Yeah. So kind of, I think a good heuristic to look at always is how much explanations company give for what they're doing. If they are cutting an earnings forecast and give a very good explanation for what's happening, you typically know that this is not just done as a reaction to something bad happening in the company, but this is it's a general economic climate. So you really want to look for executives that tell investors what's happening, and that don't kind of hide behind commonplace things, commonplace phrases. And it's something you also see kind of empirically turn out, that with forecasts that are better motivated, better explained, are typically way more accurate than forecasts that aren't. So you always want to look for the specificity in the forecast, and also for the specificity in the reaction function. So what you don't want to have is a company telling you, right, we'll deal with the economic climate by improving pricing, marketing, our supply chains. But you want to look for specific initiatives ideally with even more specificity in the timeline or in amounts, in numbers. So the more specific a company is about their reaction function and about their forecast, the more trustworthy it is to bank on these forecasts.
Yeah, I think that's a very good point. We'll come back to that trustworthy piece in a point in a minute. Shristi, do you agree with that? The looking for specifics and drilling into that, is that sort of something you have encountered in the past when you've looked at companies and looked at performance?
Yeah, definitely. Looking at the specifics is really important because it shows like how the company is functioning and everything. Like you can look at the ratios, you can look at the multiples, you can see the statements. Definitely, that's what everyone does. But you can go around and look at the annual reports. You get a lot of specifications in the annual reports because everything has been mentioned over there. So definitely, yeah, like looking at the specifications is going to help you analyze everything much better and in depth, and you're going to be having a really nice in-depth information about what the company is going through and what you can expect from the company in the future.
I think that's a
like companies have a lot of leeway about how they want to comment on things, right? I mean, there's no kind of requirement on the company to give you an explicit action plan for the next quarter to how they want to react to certain economic challenges. So it's a deliberate choice by the company. And I think it's not just a matter of, it's a good thing to evaluate an executive based on, how well thought out their plan is. It's also a matter of judging how much companies respect their shareholders. Because obviously, if you're holding back and you fall back into commonplace responses, that's it's an indication that you really think of your investor update as a chore, and you really don't want to be held responsible for a particular initiative and the success or the failure of a particular initiative. So beyond just being a signal for is the plan thought out well, it's also a signal for how much companies really care about having a good, honest dialogue with their investors. And maybe this is an aside, but one of the things we're seeing, one of the dichotomies we're seeing in the UK is not reporting much earnings right now, so we always have to rely a bit on the US for that. But kind of one of the interesting dichotomies we see right now in the US is you have companies that are falling back to commonplace things when they talk about tariffs, when they talk about the economy there. And then you have companies that are explicitly telling you, right, we're going to do these 5 things, and we're expecting these 5 things to happen in the next quarter or 2, and here's how you can judge us. And I've already seen that the companies that are explicit perform better.
Yeah, I agree with you there about companies there's no requirement there's no requirement to explain stuff, but as you say, good governance around investor engagement I think is key. I always find it very frustrating when companies will potentially get a fine for something and then report, number one, it was the previous management, which is usually a very poor way of immediately passing it on, and number 2, all of the previous management have left. So it sort of immediately makes it the past, they've left, there's no further discussion on the matter, when in fact I think an honest discussion with the investor would be about what were the root causes of that, have those root causes actually been addressed, and therefore
I think you can see that James and I both used to work for large banks.
Yes, yeah, no, absolutely. I think but that is an important point about these generic statements. You see people, you see differences between companies. Again, US example, I think it was Target, sort of saying there will never be any impact from tariffs. I think it was Target on our pricing, and we will never impact. And you think, I don't know how you can say that, with unknown territory coming in the next 1, 3, even 5 years. It's difficult to make those comments. And I'd much prefer an honest straightforward investor conversation that's, I'm not sure what the impact is yet, which is how many have actually chosen to report. You know, they've highlighted some specific impacts, and others have chosen to at least have an honest conversation about it rather than trying to stay politically on the right side of one debate or another. You mentioned about the current earnings season and UK and Europe and what's coming up. I guess to both of you, you know, who at the moment do you think out of the big retailers are, you think, on course in their next earnings releases to be giving quite a positive message, and who do you think is at risk of disappointing, particularly in relation to firms where there's, you know, durables involved? So Shristi, what's your thoughts on the current outlook and earnings? And you've mentioned some brands already you think are doing quite well. So what do you think about the winners and the, as it were, losers at the moment?
So definitely, like, starting with the risk, like some home-focused retailers like Dunelm could face like softer demands because the furniture and the home goods are very rate sensitive and closely linked to the housing market. And if fewer people are moving or renovating, they are less likely to buy any furniture. Marks and Spencer M&S, on the other hand, has done a really great job, like reviving its food division and modernizing clothing, but clothing is still on on and off for like the customer cutbacks. So the jury's out on whether it can still maintain the momentum. Then you can even like talk about like WH Smith, meanwhile, which depends heavily on travel retail, airports, train stations, and if the travel volume dips, that's a risk for the earnings. Um, on the upside, I think that the clear candidate is Curry's. Its recent results show it has well adapted to the demand shifts and the combination of the operational movements, pension de-risking, the shareholder rewards, which has investors like very optimistic review, and its share pricing hitting a 4-year high is like saying a lot then. And another potential surprise to me is B&M, which has benefited as consumers shift from mid-market to the value formats, and its positioning could make it one of the winners this season or this earning season. So the risk or the reward profile is polarized, where home goods and travels look shaky, but electronics and the discount retail could pleasantly surprise us.
No, that's a very good summary. Very good summary. Alex, who's your pick of winners and possibly stumblers?
Yeah, I think kind of for me the obvious suspect of a promising of a very interesting story is ABF, which is the Primark parent, because it is a portfolio of value investors, of value retailers. So I think this is to me kind of the interesting part. I think the interesting part very much is in the value segment, and kind of by the flip side, that leaves everything else as kind of slightly more risky. The middle market clearly is, I think, the biggest risk. But I'm always a bit skeptical on this notion that kind of luxury doesn't react to the economy so much. We've seen it with COVID that this. Yeah, it used to be kind of like a traditional folk wisdom in investing circles that luxury is immune to any impact from the economy, because billionaires still going to have billions to spend on luxury products. But luxury more and more becomes kind of driven by people that get a big bonus, that have a particular good performance in a particular year, and that is clearly going to be slightly more challenged. So luxury to me would really be the one that I'd be skeptical about going forward.
No, I think it's interesting. The back to the equation about value. You know, you think and premium, there's still significant numbers of premium mobile phones being sold, despite significant slowdowns in certain consumer groups. There's still people find enough money as that flight to quality you often hear is the phrase. People will move to that. I think for me, my picks will be JD Sports. I think is interesting with the sort of US expansion. M&S had a very decent year in 2024. And if you look at that rolling through, they've got some very fundamental pieces right, and one of my friends actually heads up the foods division now, and they've really got their act together. Although I wasn't quite sure of the strawberries and cream cheese sandwiches in the summer. If you've not tried them, they were sort of like a summer sandwich, a strawberry and cream cheese. So there's a plug there if you've not tried it. I think Dunelm for me is one I look at and think I can see there's some vulnerability there, particularly given their homeware sort of kind of space and maybe the limited pricing power. And I think that they could be a bit of a risk for me. WH Smith, they're an interesting one because, as you say, they're linked, Shristi, to travel and higher margin impulse buys. When you look at train stations, which is and travel hubs, airports, which is where a lot of their value is derived. It'll be really interesting to see how the holiday season has gone this year, because the UK's obviously experienced some very decent weather, as we described earlier. That usually has a dampening effect, and you end up, pardon the pun, sorry, a dampening effect of hot weather, but you end up with people doing staycation and not traveling, which impacts the airports, etc. But on the flip side, those numbers from what I've seen appear to be holding up quite well. And the drop in sterling, which has occurred in the last week, is almost at the end of the school holidays, which is where the huge peak season is. Because normally there's a correlation between when there's a severe drop in sterling, the amount of currency, particularly EU euro, does take a dive, and the holiday travel takes a dive at that point, even if it's just for a week or two. So I think WH Smith and the travel impact will be interesting to see. B&M, I think we've mentioned before. I think they're also pretty good on the costs. When I read some of their analysis, they seem to be very tight on cost management. And then Frasers Group, I think asset revaluation is going to be an interesting one for them, I think, when I look at what their future holds. So interesting to see your picks there. I think we're all, broadly speaking, aligned. Just carrying on quickly on the theme of sort of value and share prices. When a company gives guidance, how do you think the market knows to believe it or not? I know that's a sort of broad question. And Alex, I know there's obviously the guidance tracking within Marvin Labs. So do you want to just take that a little bit, perhaps expand on the guidance tracking for a start, but also when a company gives guidance, what are some of the key points about whether to actually go with it or not?
Yeah. So we, I think 2-3 months ago, launched this guidance tracking tool, which is basically our way of keeping track of all forward-looking statements executives make. Now, this can be like formal guidance. So, company X expects revenue to be Y for the next quarter or so. Which is what lots of companies have adopted, a formal guidance policy where they will give guidance either quarter or year out on a few data points. But it also encompasses the kind of off-the-cuff, less structured guidance, whether that's in the form of giving guidance on some metrics that are typically not included in the official guidance, or whether it's like more event-based guidance. So it's the factory is going to open in 5 months' time. We are rearranging our supply chains. Those kind of until the end of the year. Those kind of things, and we are tracking all of those and then automatically evaluating them. So on metrics, we typically evaluate when earnings releases happen, and on events, we'll actually evaluate them every day. So when there is a story in the local newspaper about the new Marks and Spencer distribution center opening, and Marks and Spencer has announced that they are doing this, we'll typically have this updated within the day. So what we're seeing there is there's a huge correlation between executives that are good in giving guidance statements to their investors and executives that are just good stewards of companies. it is probably one of the biggest correlation you can find between management quality and an objective measure for management quality. So we really like this, and I think the typical thing to look for in these guidance statements to get a sense for whether they might be well thought through or not is how specific they are, both in terms of the metric and in terms of timeliness. So are we talking about? It's easy to make a prediction for 2030 because you're not going to get called on it for the next 5 years. But if you make a prediction for the next quarter or two that is easily observable, that's more difficult. And I think the other way to look at it is how these statements are being made, how guidance is being given. Is this you typically see this in two ways being done. One of them is highly structured. It's the chief executive during a prepared remarks session on an earnings call saying, right, we are expecting this number to be that. But there are some executives that give guidance and off-the-cuff remarks. Big example of this, I know we talk a bit about the UK, but Elon Musk is kind of the biggest example of it, where like he gives forward-looking statements, basically every second. But he does this in non-structured ways, and you see this with kind of more standard executives as well, where they are responding to a question of an analyst or where they're responding to a question of a journalist by giving away some prediction about the future that some of them probably like to have walked back because it's either poorly thought out or it's not something they want to be held accountable for. So also just observing this level of discipline that people have is something that investors should be looking for. I know this was kind of a very long-winded explanation for specific, and look for it being kind of done deliberately rather than off the cuff.
No, I think that was a comprehensive answer. And it's, as you say, it's not the first time I've heard the word Elon Musk and unstructured ways go together. So I think that's a fair point. Shristi, what's your thought on guidance and how much stock do you place in people's guidance, as Alex said there, about building up trust? What's your take on that?
Yeah, I guess like Alex pretty much covered everything, but like as he said, predictions, like markets are all about expectations and not just numbers. So when a company is issuing any guidance, or as an investor or as an analyst, I would be looking at two things basically, which is like, does it line up with the broader sector trends, and is the management credible in delivering what they have promised before? And if a retailer has a history of over-promising and under-delivering, the market will discount its guidance. And conversely, if a company consistently delivers, investors reward it with a trust. And for example, like recently I've been talking about Currys a lot, and then they not only reported like strong results, but they also gave like a confident forward guidance of like a 5% profit increase, which was, I guess, because of the free cash flows by 2027 and reduced pension contributions. And the market maybe believed them, and then we saw like an approximate 17% growth. And on the flip side, sometimes a company beats expectations in the short term, but issues cautious guidance for the future. In that case, like the shares often drop down because the investors care more about what's coming next and what just happened than what just happened. So it really comes down to the expectations and the credibility. And that's why earnings season is a volatile market, I can say. And the numbers do matter, but the narrative matters even more.
I think that's a good phrase. The numbers matter, but the narrative matters even more. I mean, I think my perspective is the market's a lot less forgiving than it was maybe during COVID and the hangover from COVID. There's a lot more, I think, reaction now to poor guidance. Equally, I think on more positive, like M&S, for example, I think they've been very clear with their guidance over the last 18 months, 2 years, and I think that pays dividends in terms of to the point Alex made as well about people being more confident and not punishing them as badly. But I think there are others that continually overpromise, as we said, that end up falling onto the wrong side of it. And I mean, you raised the point about stocks dropping when results come in. It always used to frustrate me in HSBC. We'd be at the earnings call, the results would come in, there were cracking results, good ROTE and everything, and then it would just slump the moment as soon as the results were published. Now, I know often that can be to do with the dividend payout or whatever, but it used to frustrate me. I mean, what you touched on it there. Why do you think that happens? Is it specific? What is there something you think that impacts that?
I guess people do not react well to the news every time, because I've noticed every time, even if you're sitting in front of the Bloomberg, you see a news coming out, the next second you see the market going down. So I guess one of the factors can be people are not taking it really well, and it depends. Maybe people are just starting to sell off whatever they have, short selling, something like that.
Yeah. Now we've got just 9 minutes left, so I just want to swing it round to we've talked a lot about the UK market, durables, interest rates, impacts on them, premium value. We haven't really got into how AI, other than the discussion about the guidance tracking, but how AI can really help analysts during earnings season and how it makes things easier. Alex, would it be good, could you just share a little bit about your thoughts on that? Obviously, the inception of Marvin Labs plays into this. And I think also maybe good to touch upon the new AI agents and the new AI chat, because I think that's a really big feature that's just come in on Marvin that I think could help anyone trying to analyze retail stock, particularly in the durables.
Yeah, so AI is, I think, coming for being a supporting tool for investment analysts. And what we at Marvin Labs particularly focus on is on the qualitative side of companies reporting, which is something that modern day AI is incredibly adaptive. So the way we typically think about AI here is we think of AI as being a very knowledgeable colleague of yours. So what we've done when we were designing our AI chat and our AI agents, we thought of this as what would you love to have access to? I think the two things you'd love to have access to as an investor is you'd love to have access to a peer of yours that is incredibly knowledgeable about a particular company that you're kind of researching. So we've developed our AI chat with exactly that in mind. You're chatting with an expert in this company that knows the history, that knows what the company has said before, how the company's reported before. It's basically read up about on everything that the company has ever said. And you can chat with that. You can collaborate with that expert. And that's really what a well-designed AI chat for investors should be about. It should be this sparring with a colleague you respect. And then the other side of this is, so this is chat, this is interactive, this is, think through ChatGPT, right? This is your chatting. The other side of it is really AI agents. So this is asynchronous, and James was making fun of me for being unable to spell that word. But it's asynchronous interaction. So this is really your colleague that you're turning to and asking, hey, can you help me prepare a report on this? Or can you help me monitor what a company is saying when it comes in? So this really is handing off a particular task to a colleague of yours, and giving them some guidance onto what you're expected in terms of result format, and then waiting until it's finished and coming back to it. And then obviously it's kind of interacting between these two, right? Can you import the results of an agent into a chat that you can then dig into? And can you do the flip side? Can you give a chat to an agent and let them kind of go on their own and come back with research? And so really, this is what we've designed. We've designed an AI chat, which basically allows you to spar with a very knowledgeable colleague about a company. And we've built agents, which are your colleague that then will go away, do their thing, and come back with the results.
I think that description is one of the best I've come across about the differences between the chat and the agent. The colleague you spar with, and the agent, the worker that goes away and repeatedly completes tasks related to perhaps ongoing monitoring or something. I think that's a really, really good description from it. I think the other piece for me is, the ability to build research notes then on the fly more becomes more achievable, because you may have something that comes up immediately as an earnings announcement comes out that you actually want to spar on that very specific point. And that's now much easier to do with that chat feature.
Yeah, so one of the reasons why we designed it like this is something we've seen our clients do is, so we have these earnings summaries, and they are like 10, 15 bullet points deep. And what we've typically seen people then do is they are content with this level of overview for 12 out of the 15, but for the remaining 3, they want to dig down deep. So what chat with your knowledgeable colleague does is it allows you to dig down into the things that you really care about and get to the absolute bottom of it, to the extent that you need. So really, that's what aligns with the workflow of our client base. It's getting the high level on a lot of things, and then having the ability to really, really dig down into 1, 2, 3, however many things that you care about with somebody that's knowledgeable.
Yeah, and I think that's the point, about with somebody that's knowledgeable, because it's learned about that individual company, and it's focused on that individual company. Shristi, what's your take on AI and investment analysis, in particular what Alex has just said about the chat and agent functionality just launched this week with Marvin Labs?
Yeah, I think that's really helpful for the people who have very basic knowledge. It's going to be very easier for them to access information from the chatting. And I know the importance of AI because when I was studying my FRM, we had a machine learning model, so we know how exactly everything. We know that the AI is not replacing human judgment. It's just speeding up the grunt work. And the analysts still need to interpret whether the management's tone signals confidence or caution. And with the chat, which Marvin Labs introduced, it's going to be convenient and easier for the investors, the analysts, to know what's coming, what can be expected. And they can have a personal conversation. It's going to be feeling like they're going to be talking to the company itself because it has studied the company, right? And it knows everything.
That's very good.
So another thing we've seen people actually do is, just make sure to check the consistency of their views. We've had a discussion recently with somebody that was looking for an AI to help them deal with scenarios in a spreadsheet model, and the point it was less about, and that's something I found interesting. The point was less about building the scenario from scratch, and more about just making sure that the points you design in your scenario are consistent with each other, right? That you're not forecasting 10% economic growth and declining interest rates and raising unemployment. So that's something that a knowledgeable colleague of yours is very familiar with, that if you're working in an investment banking framework, right, that your VP, that your director, that your MD will spot. But if you're kind of slightly less experienced, that's something that often trips you up, that these little inconsistencies that are sometimes hard to miss.
No, that's a very good summary. Right, we are up on the hour. All that remains to be said from me is, if you want to try the new AI chat or the asynchronous agents, and I can't spell it either. So if you want to try the new AI chat and the asynchronous agents regarding retail stock, some of the names we've mentioned in the retail space in the UK and Europe, then go to the link that's in the comments on this LinkedIn Live. Thank you, Shristi, for your input. I think it's been really interesting. Thank you, Alex, as well. As always, your perspectives on both the markets and AI are excellent. So thank you to the audience for taking part as well, and follow us on LinkedIn.
Thank you so much, everyone.
Thank you so much.